This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Well, in our previous lecture, we saw how it was that we would compute for a VAT return period the amount of output tax and the corresponding amount of input tax. And that where we discovered, as is usually the case for most businesses, that the output tax exceeded the input tax, we computed the amount of VAT payable by reference to that VAT return period. And all we said at the time about these VAT return periods is that they were normally, and this is what we see here now, VAT returns are normally completed on a quarterly basis. We know what each return shows, as we've just said and we saw last time, the total amount of output VAT and the total input VAT for the quarter to which it relates. All businesses are now required to file those VAT returns, as we now look slightly more in detail at the admin of this. We've got to file the VAT returns and make the VAT payments online. Oh yes, it's all computers these days. So we've got to file and pay online, and that these VAT returns must be filed online and electronic payments made by 1 month and 7 days after the end of the VAT return period. So here's the critical time period by reference to which we must work and ensure that not only have we submitted the online VAT return, but we've also made the payment of VAT, should there of course be any VAT to pay. So, for example, for the quarter ended 30th of June 16, a business has 1 month and 7 days, so next month July into the next month, the 7th of August, until the 7th of August 2016 to file its VAT return online and electronically make its VAT payment. Usually, of course, we'd do these two things at the same time. We'd file and we would pay. So it's all done online and usually by reference, as we've seen here, to a quarterly return period. Now, what we'll discover as we go through the remainder of this chapter is although most businesses will indeed submit VAT returns on a quarterly basis, it is possible, if the business so chooses, and it might sound a little bit daft to go down this route, but if the business so chooses, they can decide to go onto a monthly basis. Now, of course, it would seem very odd that it's going to take time, it will incur administrative cost in the preparation and submission of the VAT return. So why on earth would you choose to do that on a monthly basis when it could instead be done on a quarterly basis? Why do it 3 times when you can do it just once? Well, the reason would of course be that instead of, in relation to a VAT return, the business making payments to HMRC, instead it would be the other way around, that we are able as a business to make claims for repayments of VAT. The HMRC will pay us. So, from a cash flow perspective, when would you like them to pay you? Would you like it merely following the end of a quarter or each month? Well, obviously, we'd like to get our money as soon as possible, so each month. So in what circumstances would it arise that routinely, not just on a one-off basis, but routinely, HMRC pay you? Now this, you should be able to answer based on what we've studied so far. We know that to be VAT registered, you've got to make taxable supplies. But remember, those taxable supplies could be either standard rated or 0 rated. Now, if of course a business makes mostly, if not entirely, 0 rated supplies, then that means that there is little or no output tax to charge. But if that business has standard rated inputs, then of course there will be input tax incurred. So if the input tax exceeds the output tax, HMRC owe you, the business. So on that basis, if it's routinely happening, it would make sense to submit on a monthly basis for cash flow purposes. What we'll also discover just a little bit later in our notes, this chapter on VAT, is that it's also possible to actually do annual VAT returns. There's a series of accounting schemes for VAT that were introduced by HMRC to assist small businesses. Small, as we'll see, defined in terms of the level of taxable supplies that they make. Now, the level here isn't actually that small. It will encompass a significant amount of businesses. And these schemes were introduced to help small businesses in terms of the administration of the VAT system and trying to avoid falling foul of the penalty system within VAT. Small businesses often got into trouble in terms of late submission of VAT returns, etc., and that creates problems. Now, it's not a good idea for any country's tax system to create difficulties, administrative burdens for businesses. Businesses need time, individuals who run those businesses need time to run the business. And if the business is successful, then a stream of tax revenues will flow from that. You don't therefore want to put an obstacle in that way. So, sensibly, as we'll see later in this chapter, a series of some, for us at least 3 accounting schemes were introduced to assist small businesses. One of them is the so-called annual accounting scheme that will mean that VAT returns can indeed be submitted on an annual basis. It will not, of course, mean that you only pay your VAT on an annual basis. Oh no, you can't get away with that. But the actual paperwork behind the payments, proving the overall total payment for the period, that can be done annually. So, VAT returns, normally produced on a quarterly basis. The business may choose to do it on a monthly basis, but would only do so if we got regular monthly repayments of VAT, and that's only going to happen for a business that makes 0 rated sales, 0 rated supplies, but has standard rated inputs. If the business is small, it may qualify, and then we can choose to go on to the annual accounting scheme and therefore submit VAT returns just once a year, though as we'll see later in these notes, we will have to make rather more regular payments than merely an annual payment. So, working on our quarterly basis at least, we've got a little illustration 3 to show here how it is and when it is that we would be putting together and submitting the VAT return. For the quarter ended 31st of March 16, Buttercup Limited had output VAT of £12,400, input VAT of £7,100. So the VAT return for the quarter ended 31st of March 16, we've got 1 month and 7 days by which to submit and then to electronically make our payment. So that therefore means it has to be submitted by the 7th of May 2016. How much VAT will have to be paid? £5,300, being the difference, of course, between the output tax and the input tax. That is payable and also, of course, is due by that same date, the 7th of May 16, the date by which the VAT return must be submitted and the payment must be made online electronically there. Those are the basic issues. Just a few other points here. Section C, Note C, is what we've just been talking about in terms of a business being able to choose to submit monthly returns. But of course, it would only be any point to that if we got regular VAT repayments. And as we know, that is where we have standard rated inputs, the purchases that we make, the expenses we incur, our standard rated supplies to us. We have standard rated inputs, incur input tax, but we make mostly, if not entirely, 0 rated sales. Therefore, we're always going to face a situation where we have, for a VAT return period, more input tax than output tax. Therefore, we get a repayment. Let's therefore improve the cash flow by getting monthly repayments rather than merely quarterly. Further point. If a trader's VAT liability, now that needs to change again, sorry about this, another updating error. Hopefully in the version that you're looking at you've got the correct figure, but instead of being there 2 million, that should be 2.3 million here for these so-called substantial traders. If a trader's VAT liability exceeds 2.3 million over a 12-month period, this is a lot of VAT that we are paying. then they must make monthly payments on account of the VAT liability. So they can't just wait around until the end of the quarter to make those payments. That, as you can see there, is a very serious amount, very nearly £200,000, and for businesses, of course, bigger than that, it will be well over £200,000 each month. On that basis, therefore, we have to make monthly payments on account. That is for what we call substantial traders there, substantial traders. Now, of course, the submission of the VAT return, it's all self-assessed. Again, it's all part of the self-assessment system. The business is responsible for the submission of the VAT return and the payment of VAT. Therefore, it must, of course, keep suitable records that can be checked from time to time to ensure that the correct amounts of VAT are being made. So, because, here in Note B, VAT is self-assessed, HMRC may make control visits. HMRC may make control visits to VAT registered traders. The purpose, of course, is to provide an opportunity for the HMRC to check the accuracy of the VAT returns there. We want to see the documentation that underlay the basis of the computations of the output tax and the recoverability of the input VAT. Okay, now we'll see more about these VAT returns a little bit later in this chapter, because we said we've got to deal with those accounting schemes, and one of the three accounting schemes that we know, or that we need to know here, that deal with small businesses is the annual accounting scheme. Right, next little section, something for you to read through on VAT invoices. We know that if we are VAT registered, we're going to have to produce a VAT invoice there that will be the basis for any buyer of our goods, if they are VAT registered, to be able to reclaim the input VAT, i.e. our output VAT. So there's certain information that has to be reproduced on a VAT invoice. And this section 6 deals with the information that needs to be submitted in relation to that VAT return. Now, I can't learn that for you. It's something that you simply need to look through, and you'll get some practice questions in whichever exam kit you are using to prove those particular issues. Again, very easily tested in terms of an objective testing question, where you've got 4 pieces of information. Which of those, how many of them there? Where is it 1, 2, 3, 4, however many of them, which ones are information that must be included within a tax invoice. So check that out, read it through for yourself. Next bit, most of the administration issues in terms of taxation are things that basically you need to read through for yourself, because it's a learning exercise. But here with this one, the so-called default surcharge, it's not just a learning, it's a bit of a doing exercise as well. And that's where maybe I can assist in the process, and therefore I'll talk you through this. It's the way in which we have, or HMRC, have produced for us a penalty system that if we are late in submitting our VAT returns or late in paying our tax, then we will fall foul of this default surcharge, this penalty system. Now, in fact, for quite a long time now, HMRC have been developing and introducing a new system in relation to the penalty system, but that is not yet fully implemented, and hence for our round of examinations from September 16 through to March 17 there, all of this to do with F Finance Act 2015, we're still dealing with, dare I call it, the old default surcharge system. So this is the one that we need to know. Right. To begin with, a default. When does a default occur? If a VAT return is not submitted on time, or of course a payment of VAT is made late. Now we know when, of course, we must submit a VAT return and when we must pay our tax. In each case, within 1 month and 7 days following the end of that return period. So what happens if either one or both of those is again late? So, when the first mistake is made and the late submission or late payment occurs, on the first default, HMRC issue to the trader a surcharge liability notice. They issue a surcharge liability notice. The notice will specify a surcharge period starting on the date of the notice and ending on the 12-month anniversary of the end of the VAT period to which the default relates. So if we had a VAT return period running through to the 31st of March, our first quarter of the calendar year running through to the 31st of March, and there was our first default in that period, then the surcharge liability notice would be issued and it would run to the 12-month anniversary of the end of the VAT period to which the default relates, i.e. from 31st of March 16, it would run through to 31st of March 17. So a 12-month surcharge period. Now then, at this point, there is no penalty that we have to pay. But we're now on notice that if we do it again within this 12-month period, then there may be a penalty that we have to pay. So, if the trader has a further default during the surcharge period, there will be two consequences. Firstly, the surcharge period is extended to the 12-month anniversary of the VAT period to which the new default relates. So if, having prepared our VAT return but either submitted it late or paid late for the quarter to 31st of March 16, then we're on a surcharge period through to the 31st of March 17. If we make again a further default, we again pay late or submit late in, say, the 3-month return period to 30th of September 16, then a further extension of our surcharge period would now go through to the 30th of September 17. So the surcharge period is extended to the 12-month anniversary of the VAT period to which the new default relates. So we're going to run on for a further 12 months. If the default involves the late payment of VAT, then the trader will be subject to a surcharge penalty. There is therefore no surcharge penalty where a late VAT return involves the repayment of VAT. If we're, of course, just late submitting and we're due a repayment, then there's no surcharge penalty. But if this is usually the case, we should be paying them, then there is a surcharge penalty. Now, how do we establish the amount of this surcharge penalty? Well, to begin with, it depends on the number of defaults within this concurrent running surcharge period. Default in the surcharge period. The first one, surcharge as a percentage of the VAT unpaid at the due date. We start at 2%. Then as we go through a second, third, fourth or more defaults, the percentages get rather higher. 5%, 10% to a maximum 15% there. However, HMRC are still reasonable in terms of how they apply this, and surcharge penalties at the rates of 2% and 5%. So for the first and second defaults there within our surcharge period, they are not made for amounts less than £400. So we're only going to have to pay out if the amount involved on this penalty is more than at least £400. When we get up to our third and fourth and subsequent surcharge defaults here, where the rate of surcharge is 10% or 15%, the minimum surcharge is £30. So you do your normal calculation on your 10 or 15%. It comes out less than 30. The minimum payment will be £30. In order to escape, as it were, there's a good word, escape from the surcharge liability period, this surcharge period, the trader must submit 4 consecutive quarterly VAT returns on time and also pay any VAT due on time. We've got to get it right for 4 consecutive quarterly VAT return periods there. Right, let's see how that works, therefore, in relation to example 6. State the consequences for Bluebell Limited of the late submission of the VAT returns. So the first thing that you've now got to do look through the quarter ends that you've got for the VAT return periods for Blue Belt Limited. You're told the date when the VAT returns were submitted, and you've got to work out, therefore, where a default has occurred. And then establish, of course, based on the first default period, the surcharge period, and on that basis then go on to see are there subsequent defaults that will therefore require any penalties to be paid. So just work through that for yourself for a moment. I'll run you through that again when you've had your own attempt at it. But look at those dates submitted, see where we have a problem in terms of late submission of the VAT. We're told that Blue Belt Limited paid the VAT due on the same day as the VAT returns were submitted, so it's one and the same there. So look to see where we've got a default, find your surcharge period, and work out therefore any surcharge that may arise. Okay, just pause this while you have a go at that for yourself, and then we'll look through it together once you've attempted that exercise. Okay then, let's see how we have got on. Now, our first quarter ended the 30th of September 14 there, as we go through these. Date submitted 5th of December 14. Right, that of course is late. Remember, we've got 1 month and 7 days. So 1 month and 7 days on from the 30th of September 14 would have been the 7th of November. Therefore, that date, 5th of December rather, is late. So what does that mean? It means that in relation to the quarter ended the 30th of September 14, HMRC will issue a surcharge liability notice specifying a surcharge period that will run through 12 months from that quarter end date, so through to the 30th of September 2015. So they'll issue a surcharge liability notice, and the surcharge period will run 12 months to 30th of September 15. We then move on to the next return. December 14, 1 month and 7 days after, would have been due for submission on the 7th of February. We, of course, again were late there, the 2nd of March 15. So on that basis, we have got our first default. Our first default there, that means 2% as our surcharge in relation to the amount due. There's the amount due times 2%. Work that figure out. Does that figure exceed 400? Remember here, surcharge penalties at the rate of 2% and 5% are not made for amounts less than £400. You will discover when you put that through your calculator that it just does indeed exceed 400. I think it comes to £426. So there will be a surcharge of £426 to pay, and of course a second effect. Remember, there were two impacts of a subsequent default. One, we may have to make a payment, as we would here, a surcharge penalty of £426, and whatever, the surcharge period will now be extended to a date 12 months after the end of this return period, so it will now run through to the 31st of December 15 instead of just the 30th of September 15. We then go through the next few quarter ends. 31st of March, well, the due date there, 1 month and 7 days would be the 7th of May, submitted 25th of April, therefore no problem. To 30th of June, submission date 1 month and 7 days, 7th of August. July, okay. To September, then that would be the 7th of November, and we submitted 25th of October. And then December 15, remember now, if we get these 4 consecutive VAT return periods, we'll come out of the surcharge period. 31st of December 15, we need to have submitted by the 7th of February 16, tick, 27th of January, we did it. So we've got therefore the 4 return periods that now had their VAT return submitted on time. So we come out of the surcharge period. But then of course what happens? We fall back into our bad ways. 31st of March 16 should have been submitted 7th of May. That was the 16th of May, and therefore we start all over again. That late submission for the quarter to 31st of March 16 will result again in a surcharge liability notice, specifying of course the surcharge period running for 12 months from the end of that return period, so through to the 31st of March 2017. Okay, have a little read through if you haven't indeed already at the model answer, so pause at this point and then we'll come back and continue with our studies of VAT. In terms of the penalty system that applies in respect of VAT, probably the most well examined of those areas is, as we have here in section 7, the default surcharge. Let's remind ourselves about what was happening. That of course arose where we had a VAT return that was either submitted late or the payment was made late. So in terms of our VAT return, we've either submitted it late or then gone on to make the payment of VAT late. Again, probably the most tested of the penalty areas. But in section 8 that we now move on to, we see other areas of where the penalty system also comes into play. Now, the first of those areas here in section 8.1 is way back at the very beginning of your life with VAT. And that is if you've had a failure to notify your liability for registration. The other part of this, which is the same rules, we've had a change in the nature of supplies by persons that have been exempted from registration, but now of course they're not. Now here what we'll discover is that there's a standard penalty based on a percentage of the VAT lost during the period from when the notification should have been made, and quite obviously through to when it is actually made. Now this standard penalties given here, the actual penalty payable is linked to the taxpayer's behaviour. Now that therefore runs from, at best, there will actually be no penalty at all where the taxpayer has a reasonable excuse for the failure to notify. So that's as good as it can get. No penalty, reasonable excuse for the failure to notify. All the way through to there being a penalty of 100% of the tax unpaid, where there is deliberate failure to notify with concealment. Deliberate failure to notify, and with concealment you've tried to cover it up. In between we have got 30% and 70% of the tax unpaid as penalties. The 30% penalty arises where the tax unpaid there, where it's a non-deliberate failure to notify. It is a failure. Again, you don't have a reasonable excuse. It is a failure here, but it wasn't deliberate. So there, 30% of the tax unpaid. Where, of course, we have a deliberate failure to notify, the penalty goes up to 70% of the tax unpaid. And we'll see that type of scheme where we go from no penalty through 30, 70, 100% there. That we'll find also when we look at the admin systems that apply in terms of income tax and corporate tax. Again, a similar scenario will arise. What we'd also discover, though the detail of which we do not have to know, a penalty will be substantially reduced where the taxpayer makes a disclosure, especially when this is unprompted by HMRC. So the taxpayer realises that there has been an error made and therefore owns up to that. And it is unprompted. The HMRC have not said that they're going to investigate. And what happens is we discover as the trader, oops, we've made a mistake, and we go forward and tell HMRC that. So if that happens, then the penalties are reduced. Again, obviously encouraging, therefore, taxpayers to, as it were, come clean in relation to as soon as they become aware that a mistake has been made, they actually do that. So they come forward and say, oops, sorry, we should have notified registration, now we're doing it. Once you're registered, as we know, if you are late submitting the VAT return or late in paying the VAT in relation to that return, we've got our default surcharge system. What about now? The second section, where there are errors in the VAT return that we have submitted. So a trader that makes an error in a VAT return that results in the underpayment of VAT can be subject to a standard penalty for submission of an incorrect return. Standard penalty for submission of an incorrect return, and the penalties applicable to the submission of an incorrect return, which lead to the understatement of the VAT liability or a failure of inflated claim for repayment of tax, i.e. we have put in a VAT return that gave rise to a repayment of tax and actually it shouldn't. That was an inflated claim. We've discovered that there was an error and therefore we should not have had that level of repayment. Either way, we're not paying sufficient VAT or they are repaying to us too much. So there are submissions of an incorrect return leading to either of those two things, and then the penalties, again, similar to what we've just been talking about. No penalty. Taxpayer simply made a mistake, through to penalty up to 100% of the understated tax, where there is also concealment of the error. In between, 30% of the underpaid tax, 70% of the underpaid, understated tax there. 30% the taxpayer fails to take reasonable care, as opposed to 70% where of course the error was deliberate. Again, very similar to what we've just seen in terms of the penalties that arise when you fail to notify your requirement to register for VAT. Now, in terms of these errors in a VAT return, there may be the standard penalty computed as we have just seen for the submission of an incorrect return, and there may also be penalty interest. Now, the different situations that we may find ourselves in. The main issue that is tested and which we need to be able to do a calculation of is whether or not the net errors are less than a de minimis limit, or whether the net errors are more than this de minimis limit. Now, the de minimis level, this de minimis limit here, is the greater of, in terms of the error in the VAT return, either the underpayment of tax or the over refund of tax, £10,000 and 1% of the turnover for that VAT return period. Notice this de minimis level is the greater of those two. Now, if the net error is less than that de minimis limit, then it can be voluntarily disclosed by the trader, and correction is very simple. Correction is then made by simply entering the errors on the next VAT return. Now, again, based on the information down there may be a penalty for submission of an incorrect return, but there'll be no interest charged. No default interest will be charged here. If the net errors, on the other hand, are more than the de minimis limit, so greater than 10,000 or 1% of the turnover, subject to that upper limit of 50,000 as it says there, if our net errors are more than the de minimis limited, then can again be voluntarily disclosed by the trader. But in this case, the trader must disclose the errors separately to HMRC. We cannot simply adjust the error on the next VAT return, and penalty interest will be charged. And as we've seen, there may be a penalty for submission of the incorrect return. Now, I said up here that there are three different situations. The third one, errors may be discovered as a result of a control visit. HMRC, as we know, will make control visits to make sure that we have been correctly submitting those VAT returns. Well, if it's discovered as a result of that, rather than we actually volunteering that information when we discover the error, both a penalty for submission of an incorrect return and penalty interest can indeed be charged. Okay, now with that information, what I'd now like you to do, well, have a little read through it. We've gone through quickly there, so you'll need to get your head around that. Don't try at this point to sit down and actually learn it, because it won't work that way. what you need to do is to practice by the use of examples. Now again, with your exam kit from whichever approved provider you have decided to purchase your exam kit, there will be many exercises. Again, it's an area which can easily be tested in objective testing question form. And I would recommend that you will learn this by working those exercises, referring back to begin with to the notes here, looking at getting to grips with, getting to understand what these very strange terms mean. We've got a little example here in these notes that I would wish you to have a go at. The question is stated that it's about an error and how that would be disclosed to HMRC and what penalties and, if applicable, interest will be charged by HMRC, where the scenario, the company has made an error relating to understated output VAT of £8,500 on the VAT return. We've made an error on the VAT return. Here we've made it for the quarter to the 31st December 15, and we're told, remember, you've got to look at, in terms of errors on a VAT return, at whether or not the net errors, £8,500, are within or outside of the de minimis limit. Are they less than or more than the de minimis limit? Remember, the de minimis limit, first calculation you will do, was the greater of two figures. One, a figure that is given, £10,000 that you have to learn, and the other, 1% of turnover. There's the turnover, £700,000. Then look back to your notes. I'm not expecting you to remember it at this stage, at what therefore the outcome would be in terms of, if I take you back, the submission of the incorrect return there, whether any of these are going to be relevant, and whether any interest payment would be due. So give some thought to that, please, and then come back and we will discuss through that. So our answer here in terms of how we may disclose this to HMRC and what penalties or interest may be charged by HMRC again rest on whether or not those net errors, here £8,500 understatement of output VAT, whether those net errors are less than or more than the de minimis limit, the de minimis level. And that de minimis limit is set at the greater of £10,000. Well, no, £8,500 is not greater than 10,000. 1% of 700,000, well, that would be 7,000. And of course, what you see here is that 8,500 is more than 7,000, but is not more than 10,000, in between it. And this tests out whether or not we have remembered correctly the de minimis level rule, which is that the de minimis level is set at the greater of those two figures. So that makes it £10,000 because that is bigger than 7,000, and 8,500, of course, is less than that de minimis level. So what we've got is that the net errors here are less than the de minimis level. On that basis being less, we are able to, how do we tell HMRC about this? We will disclose it on the next VAT return. As this was the VAT return to 31st of December 15, then the company, who are they, Blanche Limited, would have to show that on the VAT return for the quarter to the 31st of March 16. Now, if we do that, then no interest will be charged by HMRC, but of course there may be a penalty for submission of the incorrect return. That could indeed be imposed. Now that, of course, where it will depend. If it is simply a genuine mistake made by the company, then there would be no penalty for submission of the incorrect return. On the other hand, if HMRC believes that Blanche Limited failed to take reasonable care, that's why we've had this error arise, then the penalty may be 30% of the underpaid tax. The underpaid tax, again, of course, seeing there, £8,500. Okay, well that brings this particular session to an end. It leaves us with probably just one more quite lengthy session still to do, where we'll deal firstly with the accounting schemes that are available to assist small businesses. You see a couple of the main ones creeping in here at the bottom of this page here. The cash accounting and annual accounting schemes. You may recall we have already mentioned the annual accounting scheme, where it is possible that instead of submitting VAT returns on either a quarterly or indeed a monthly basis, we'd be able to do it on, a bit of a giveaway in the name, on an annual basis, submit a single annual VAT return. Now, both of these schemes are only available in relation to small, in inverted commas, businesses. Now, we'll have to see what do we mean by small, who will be eligible to join such a scheme, what will be the impacts of joining such a scheme, and where, very specifically with the cash accounting, might this be a good idea? Where would we actually suggest, yes, this is good news for your business, it would be sensible to join and opt for the cash accounting scheme. There's another accounting scheme that we'll see, it's called the flat rate scheme, but that, as we will see next time, is for a very much smaller level of business. A couple of other more interesting areas as well to deal with in that final session, to bring us then to a conclusion on what of course is the last of the taxes that we now need to study in relation to our syllabus. I look forward to finishing it off with you then.